Welcome, I'm Christian Paradise, a forex trader. In this video, we're learning what is liquidity and what are its concepts. Liquidity in forex trading means money. You can further explain liquidity as the ability to buy or sell currency pairs quickly and at stable prices without causing significant market impacts. The forex market is the most liquid globally, with over 7 trillion in daily volume, driven by major pairs like Euro USD during peak hours, example London, New York overlap. So we have high liquidity and low liquidity. High liquidity has numerous traders, enable fast trades, tight spread, low slippage, and minimal costs. Peaks during major sections like London and New York, which are the best sections to trade. Major pairs are best to trade. Example, Euro USD, GBP USD, and gold. Low liquidity has fewer participants, cause wider spreads, higher slippage, gapping, and risks common in off hours, holiday, or exotic pairs, example USD JPY. Market overlap. Sections overlapping boost liquidity. Example London, New York overlap. That's from 2 p.m. to 6 p.m. West African time. Handles 70% volume, offering tightest spreads and best conditions. Other like Sydney sections and Tokyo section overlap. In summary, best time to trade: 1. London, New York sections. 2. During overlap. 3. High impact news, example CPI, NFP, will trade news with caution. Concept of liquidity: we have 1. Draw on liquidity, that's the internal and external liquidity. 2. Liquidity sweep and liquidity run. So for internal and external liquidity, this is just like internal liquidity, you can refer to it as IFVG. That's some persons will call it IFVG, that's internal fair value gap, imbalance, fair value gap. So just having a market structure like this, it's this is a bullish market. So let's say at this point there are some fair value gap here that you want price to grab before pushing price to the before the continuous push of price to the upside. So this will now serve as your internal fair value gap or the imbalance, what have you. So you want to see price do this, grab liquidity here, and then take price to the upside. So this for internal fair value gap. Why external fair value gap is, let's say for instance, this is still a bullish market. Let's say price is coming down here and then price is going up. Our external liquidity or drawn liquidity is this key point here. So that will be on drawn liquidity or external liquidity. So we want to see price push to this upside, right? So that's it for internal and external liquidity. So let's look at some examples in our chart. So first you need to use the 4-hour time frame and then make sure you on your fair value gap indicator. So that's the nephew underscore Sam indicator. So now this is let's take this as our example. Where's it? So now if this is our structure that we're working with, this break of structure, so we can see clearly we have internal fair value gap and our external drawn liquidity or external liquidity should be this point that I've marked here, this particular point here. So we want to see price push and grab some liquidity from this internal and push price to the external. All right, so the last concept is the liquidity sweep and liquidity run. So liquidity sweep is just like it going to the external to pick some liquidity there, and the liquidity run just like continuous movement in that direction after breaking structure. So if we're using this, let's use this, a bullish market. So liquidity sweep is when price, let's say, no, let's use this, so liquidity sweep. Now this is our last point here. This point is the last point. Let me take that. Here's the last point. So liquidity sweep is most times it will just come, it serve as an external liquidity too. It will just come, grab liquidity here, and then push price to the upside. So it's still a bullish market, but it has grabbed liquidity, it has swept liquidity from this external level, and it has pushed price to the upside. So most time to close with a wick instead of full candle body, you see wick, very long wick like that, and then push price to the upside. While liquidity run is just after a break of structure, let's say after this break of structure, it will now after the pullback, it will now break structure and then to continue that run. So most time it closes with the candle body. So we have this point as the run on liquidity. So liquidity run. So it will run above previous structure and then continue in that movement. So let's see example. Okay. All right. Sorry. Now this is it. So we have this as liquidity sweep. This point here. Where's this? We have this point here as liquidity sweep. While this as liquidity run. So there won't be time for plenty examples, but just go into your chart and try to note this point, and you see how it's very, very, very effective in the market. So I have two videos on TikTok here. One, understanding market structure. Two, when the trend is your friend and when it's not. So if you don't have a good knowledge, or you're still finding it difficult to mark your structures properly, you should go and watch those two videos. And I have a trading model for those that don't have any trading model. I have a trading model on my Twitter pinned there. So my Twitter is at Adjus Paradise. That is ADJUSPARADISE. So all the best until next time. Thank you.